Happy New Year, everyone. It is December 31st, 2025. While you are popping champagne and making resolutions to hit the gym, the President of the United States is at Mar-a-Lago making a resolution that could incinerate the value of the dollars in your savings account. We just got word from a press conference on Monday. President Trump isn't just looking for a new Federal Reserve chair. He is actively musing his word about firing Jerome Powell before his term ends. And the reason? It's not just interest rates anymore. He's threatening a lawsuit over, wait for it, office renovations. This isn't just political theater. This is the financial equivalent of removing the control rods from a nuclear reactor because you want the energy prices to go down. The most powerful central bank in the world, the guardian of the global reserve currency, is currently caught in a hostage situation. If you own the S&P 500, if you are looking to buy a home in 2026, or if you simply eat food and pay rent, you are standing in the blast zone. Tonight, we aren't just talking about who gets the top job. We are investigating why the war for the Federal Reserve is the single biggest risk to your wealth in 2026. Buckle up. The sacred independence of the Fed is about to get a pink slip. Let's look at the facts on the ground. It is the last day of 2025. The Federal Reserve, under Jerome Powell, has cut rates at the last 3 meetings. They are trying to engineer a soft landing. But for the White House, soft isn't good enough. They want aggressive, sweeping cuts to lower mortgage rates and juice the stock market before the midterms roll around. But here is the friction point. The Fed officials signaled earlier this month that they are planning only one rate cut in 2026. 1. That is not what Trump wants. And when Trump doesn't get what he wants from the Fed, things get volatile. On Monday, he told reporters he would love to fire Powell. He said Powell should resign. Now, we saw a preview of this movie back in July. Remember that? The White House floated the idea of ousting Powell, and Wall Street absolutely puked. Bond yields spiked, the dollar wobbled, and the administration had to walk it back. But this time, the president feels emboldened. He says he has a successor picked out. He says he will announce it sometime in January. He is holding a sword of Damocles over the neck of the U.S. economy. Why does this matter to you? Because the entire global financial system rests on one fragile assumption: trust. Investors in London, Tokyo, and Dubai buy U.S. Treasury bonds, the debt that funds our government, because they believe the Federal Reserve is independent. They believe the Fed will fight inflation even if it makes the president angry. If that independence is shattered, if the Fed chair becomes just another political appointee doing the bidding of the Oval Office, the risk premium on U.S. assets skyrockets. That means higher yields on bonds, which mathematically forces stocks down. It means the dollar loses its status as the safe haven. When the president says, "I might still fire him," he isn't just threatening a bureaucrat. He is threatening the structural integrity of the bond market. And if the bond market breaks, your 401k is collateral damage. Here is where the story gets bizarre, and frankly, dangerous. The Federal Reserve Act, the law that created the central bank back in 1913, was designed to stop a president from firing the chair just because they disagree on interest rates. The law states the chair can only be removed for cause. For over a century, legal scholars assumed cause meant criminal behavior. Taking bribes, insanity, or dereliction of duty. It was never intended to mean keeping interest rates too high. But Trump has found a potential loophole. He mentioned considering a lawsuit for gross incompetence related to an ongoing renovation project at the Fed's headquarters. Think about that. This is the Al Capone strategy. They couldn't catch Capone on murder, so they got him on tax evasion. Trump can't fire Powell for monetary policy without crashing the market, so he's going to try to fire him for building maintenance? It sounds petty, but legally, it is a masterstroke of chaos. If the president sues the Fed chair for administrative incompetence, it creates a legal gray zone that could last for months. Imagine the scenario in January 2026, the Fed Open Market Committee meets to decide on interest rates. Jerome Powell sits at the head of the table. But simultaneously, he is defending himself in federal court against the President of the United States. Does the market listen to Powell? Or do they listen to the shadow chair that Trump is about to announce? Uncertainty is the enemy of value. If Wall Street doesn't know who is actually driving the bus, they pull their money out of the market. We are talking about a potential liquidity freeze. When banks get scared, they stop lending. When they stop lending, businesses stop hiring. This renovation lawsuit is a match being thrown into a warehouse full of dynamite. To understand why this is terrifying, we have to travel back in time. We need to look at the last time a U.S. president successfully bullied a Fed chair into submission. The year was 1972. President Richard Nixon was up for re-election. The Fed chair was Arthur Burns. Nixon wanted the economy booming to secure his vote. He was caught on tape, literally, the Nixon tapes, telling Burns to kick him in the ass and lower interest rates, regardless of the inflation risk. Arthur Burns caved. He kept money cheap. He let the money printer run hot to please the president. The result? Nixon won the election in a landslide. But the American people lost the decade. Inflation exploded. We entered the era of stagflation, stagnant growth combined with sky-high prices. By the late 70s, mortgage rates hit 18%. The stock market was dead money for over a decade. It destroyed the middle class's purchasing power. This is the wallet connection you need to understand. When Trump demands aggressive cuts to lower mortgage costs, it sounds great on paper. Who doesn't want a cheaper mortgage? But if those cuts come when the economy is already heating up, or when supply chains are tight, you get the Arthur Burns effect. You might save $200 a month on your mortgage, but you'll pay an extra $400 a month for gas, groceries, and insurance. The Federal Reserve's job is often to be the buzzkill. Their job is to take away the punch bowl just as the party gets going. If Trump installs a yes man who keeps the punch bowl flowing, the party gets wild for about 6 months. The S&P 500 might hit 7,000. Everyone feels rich. And then, the hangover hits. And the hangover is hyperinflation. If you are holding cash or long-term bonds, a politicized Fed is your worst nightmare. It guarantees that the value of that currency will be diluted to fund political ambitions. This is why gold and Bitcoin have been rallying every time Trump attacks Powell. The market is sniffing out the debasement of the dollar. So, who is waiting in the wings? Trump said he'll make the announcement in January. Let's profile the finalists, because one of these men will control the price of your money for the next 4 years. Contender 1, Kevin Hassett. The current favorite. He's the director of the National Economic Council. The profile, Hassett is a loyalist. He was a key architect of the 2017 tax cuts. He believes in supply-side economics. The market reaction, Wall Street views him as a known entity, but he is seen as incredibly dovish. If Hassett gets the nod, expect a sugar rush rally in stocks. He will likely push for the aggressive cuts Trump wants. But remember the hangover. Hassett at the helm means the inflation vigilantes will be watching closely. Contender 2, Kevin Warsh. A former Fed governor. He's the banker's choice. The profile, Warsh is interesting because he has criticized the Fed for being too easy in the past. However, he has recently realigned himself with Trump's orbit. The market reaction, this would be the safe pick. Warsh understands the plumbing of the financial system. He's less likely to burn down the house than a pure political appointee. If Warsh is picked, the dollar might rally, and bond yields might stabilize. He offers a veneer of independence. Contender 3, Rick Rieder. The dark horse from BlackRock. The profile, Rieder is the CIO of global fixed income at BlackRock. He manages more money than the GDP of most countries. The market reaction, this is the Wall Street insider pick. Rieder knows exactly what makes the market tick. But there is a massive conflict of interest here. A BlackRock executive running the Fed? The Fed put the idea that the central bank will always bail out the stock market would become official policy. Great for your stock portfolio in the short term, terrible for wealth inequality and social stability in the long run. Trump has also mentioned Christopher Waller and Michelle Bowman, current governors. But let's be real, Trump wants a disruptor, not an institutionalist. The shadow chair strategy, here is the twist. Powell's term as chair doesn't end until May 2026. But Trump is announcing the successor in January. Why? He is creating a lame duck session that lasts 5 months. By announcing the new guy now, he tells the market, ignore Powell. He's history. Listen to the new guy. It neuters Powell's power without actually firing him. It's a psychological coup. There is one more layer to this onion, and it is purely vindictive. Jerome Powell wears 2 hats. He is the chair of the Federal Reserve, and he is a member of the Board of Governors. Usually, when a chair steps down, they resign from the board too, out of respect. But Powell? Powell might not be in the mood for respect. If Powell decides to stay on the board until 2028 just to spite Trump, he blocks a seat. He denies Trump the ability to appoint another loyalist. He stays in the room, voting on rates, dissenting against the new chair, and leaking arguments to the press. Imagine the toxicity. The new Trump-appointed chair tries to cut rates, and Jerome Powell, sitting right next to him, votes no and gives a speech about why the new chair is reckless. It's dysfunction junction. Why should you care? Because markets hate dysfunction. If the Fed becomes a reality TV show of infighting, the volatility index will scream. We could see days where the Dow swings 1,000 points based on who leaked what memo. And remember, Trump is musing about firing Powell. If he tries to remove Powell from the board entirely, that goes to the Supreme Court. We are talking about a constitutional crisis over monetary policy. So, as we head into 2026, how do you position your money? Let's game out the 3 most likely scenarios. Scenario A, the purge. Trump uses the renovation excuse to fire Powell. Powell sues. Outcome, chaos. The US dollar tanks. Gold shoots to $4,000 per oz. Long-term treasury yields spike to 6% or 7% because investors demand a premium for the chaos. Your move, this is the worst case scenario for stocks. You want hard assets. Real estate, gold, commodities. Cash is trash in this scenario because the institutional credibility is gone. Scenario B, the submission. Powell sees the writing on the wall. To avoid the lawsuit and protect his legacy, he gives Trump the cuts he wants. He abandons the one cut in 2026 plan and slashes rates in March and May. Outcome, the melt-up. Stocks go parabolic. Housing prices surge again because inventory is still low. But inflation returns by late 2026. Your move, ride the wave, but keep a finger on the eject button. This is a bubble forming. Tech stocks and growth stocks will fly. Scenario C, the Cold War. Trump announces the new guy in January. Powell ignores him and keeps rates steady, maybe even hikes if inflation ticks up, just to prove a point. Trump screams on Truth Social every day. Outcome, a grinding, choppy market. Businesses delay investment because they don't know what the rate will be in June. The economy slows down. Your move, high quality, dividend paying stocks. Companies with strong balance sheets that don't need to borrow money. Defensive plays like healthcare and consumer staples. The Federal Reserve was designed to be the adult in the room. It was designed to be boring. But in 2026, boring is dead. We are witnessing the politicization of the very foundation of capitalism. Whether you love Trump or hate him, you must acknowledge the economic reality. When politicians control the money printer, the money eventually becomes worth less. The tease we heard on Monday, the threat of a lawsuit, the "I'd love to fire him" comment, is a signal. The era of the independent central bank is ending. We are moving toward a world where monetary policy is just another arm of the campaign trail. For the investor, this means the rules are changing. The Fed put is no longer about financial stability, it's about political polling numbers. So, as we step into this new year, don't just watch the stock ticker. Watch the court dockets. Watch the appointments. Because the man sitting in the chair at the Federal Reserve matters more to your wallet than the CEO of any company in your portfolio. If Trump gets his way and decapitates the Fed, we might get a short-term party. But make no mistake, the bill is coming due. And it will be paid in the currency of inflation. Thanks for watching. If you want to survive the volatility of 2026, make sure you subscribe and turn on notifications. We're going to be tracking every move of this succession crisis. Happy New Year. Good luck. You're going to need it.